Palantir just dropped second quarter 2026 earnings that CEO Alex Karp flat out called otherworldly. And honestly, when you look at the sheer scale of their revenue growth and this absolute explosion in commercial demand, he isn't wrong. The business is executing at a level that most enterprise software companies literally can only dream of. But this undeniable momentum is colliding headfirst with a massive, unavoidable tension, and that is the price tag. We are looking at a company priced for absolute perfection, and it has created one of the most intensely polarizing battlegrounds in modern finance. There are billions of dollars at stake on both sides of this trade right now, with institutional investors being forced to answer one really uncomfortable question. Is Palantir building the most important software monopoly of the 21st century, or is this the exact setup for a spectacular valuation collapse?
Because this number right here, this is exactly why the market is tearing itself apart. As of August 2026, Palantir trades at a staggering 141.6 times trailing earnings and roughly 78 times forward earnings. To put that into historical context for you, traditional value investors will tell you a multiple this high is almost universally a giant red flag. It is a valuation that leaves absolutely zero margin for error. Think about what this implies for a second. The market is already pricing in a future where Palantir captures a massive, uncontested share of the global artificial intelligence rollout. Now, if Palantir truly cements a monopoly as the premier operating system for the AI revolution, well, this premium might actually be justified, and the stock could still compound for years. But the math behind a 140 times multiple is completely unforgiving. If they face any kind of growth deceleration, any macro headwind that slows enterprise spending, or any bottleneck in scaling, a stock priced at this level is primed for a disastrous fall. The floor is incredibly far down.
And this brilliantly illustrates how deeply divided Wall Street is right now. On one side, you have the mega bulls. Bank of America threw out a street-high $255 price target, and firms like Baird are officially classifying Palantir as the premier AI growth asset in the entire market. They see a company that has effectively solved the enterprise AI puzzle while everyone else is still scrambling to build the pieces. On the exact opposite side, you have the valuation skeptics. Jefferies maintains a heavily bearish $70 target. They argue that a multiple this extreme means the stock is just priced for a reality the company cannot possibly sustain. In their view, if revenue growth slips even a few percentage points, or if Microsoft and Google start offering comparable tools for a fraction of the cost, that multiple is going to compress violently, wiping out billions in shareholder value. So what is the market actually missing here? Or better yet, what is the underlying economic engine that makes these massive institutions willing to pay this kind of premium in the first place?
Section 1. The economic engine. What drives the premium?
To understand why Palantir commands this valuation, we really have to look past the headline numbers and deeply understand what they are actually selling, who is buying it, and why it is so incredibly difficult to replace once it's installed. The absolute best way to grasp Palantir's competitive moat is to compare it to the alternatives that enterprise chief information officers are staring at every single day. Most modern data platform majors, like Snowflake or Databricks, or hyperscalers like AWS and Google, offer what is essentially a build-your-own approach. They give you incredible cloud storage, super powerful computing resources, and a massive toolbox of developer tools. But here is the friction point. Your internal IT department has to spend months and sometimes years building custom application layers, cleaning data lakes, and writing complex code just to make that data useful for a single business application. And by the time it's done, the architecture is usually pretty brittle. Palantir does the exact opposite. They aren't selling you a box of parts. They are selling you a unified operating system. They provide an out-of-the-box digital twin of the business, which they call the semantic ontology. Instead of leaving data siloed in 20 different departments, the ontology maps out real-world objects, like a manufacturing plant, a supply chain route, or a specific piece of machinery, right into a unified digital environment. Both technical and non-technical staff can then interact with this environment, asking questions and deploying AI agents securely without ever having to migrate databases or write endless lines of custom integration code. They are selling speed and operational reality, not just infrastructure.
It's really like a giant puzzle, and these four foundational platforms interact to create that massive ecosystem. This effectively acts as a gravitational pull on their total addressable market. First up, you have Gotham, which is their intelligence fusion platform built specifically for national security and defense. This is the software that maps real-time battlefield threats, tracking everything from satellite imagery to troop movements. Then you have Foundry, which is the commercial equivalent of that. Foundry creates that digital twin for massive corporate entities. Think mapping global supply chain disruptions for a multinational manufacturer or predicting inventory shortages for a major airline. But sitting right up top of both of those is the real catalyst for their current explosive growth, and that's AIP, or the Artificial Intelligence Platform. Now, it is absolutely crucial to understand that AIP is not a standalone large language model trying to compete with ChatGPT. It's a model-agnostic orchestration layer. It allows companies to plug in whatever the absolute best language model happens to be that day, whether that's from OpenAI, Anthropic, or Google, and securely route tasks dynamically across their proprietary data without leaking their corporate secrets back to the public model. And finally, you have Apollo. Apollo acts as the continuous delivery system behind the scenes, enforcing zero-trust security updates across public clouds, private servers, and even completely air-gapped military environments. When a company buys into this stack, they aren't just buying software. They are fundamentally rewiring how their entire organization processes reality.
But having the most advanced software in the world doesn't mean a thing if you can't sell it efficiently. And this is exactly where Palantir has completely disrupted the traditional enterprise software playbook, effectively solving the biggest bottleneck in the AI revolution, which is adoption. In a standard enterprise software procurement cycle, you are looking at 12 to 18 months of endless PowerPoint presentations, proof of concept negotiations, and brutal IT security audits before a single line of data is even processed. Palantir just bypassed this entirely by introducing these intensive, hands-on keyboard bootcamps. In under 5 days, they bring a client's actual engineers and executives into a room. Step 1, they ingest the client's messy, real-world, unstructured data. Step 2, they build out a baseline ontology right then and there. And Step 3, they deploy functional AI agents that solve a highly specific, high-value business problem. Think about a logistics company figuring out how to reroute cargo around a blocked port in real time. Palantir is showing immediate, undeniable operational return on investment in less than a week. This compresses the sales cycle violently and drives massive trial-to-paid conversion rates. It is a land and expand motion on absolute steroids.
This go-to-market motion fuels a really powerful, deeply entrenched recurring revenue engine. And by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed. Looking at the full fiscal year 2025 breakdown, 54% of their revenue still comes from sovereign and government contracts, while 46% comes from the commercial enterprise side. But we really need to talk about the quality of that government revenue. Government contracts, especially in defense and intelligence, are notoriously difficult to win. But once you are in, the switching costs are astronomical. It is practically a lifetime annuity. This government business is heavily concentrated in the US, and it's protected by a nearly impenetrable regulatory moat. Palantir holds incredibly rare Impact Level 5 and Impact Level 6 defense accreditations from the U.S. Defense Information Systems Agency. To put that in perspective for you, Impact Level 6 actually allows the handling of data classified up to secret. The barrier to entry, the sheer time, and the financial cost for a standard Silicon Valley software company to achieve that level of security clearance is just staggering. They essentially have a legalized monopoly on certain classes of high-level government data processing. That provides an ironclad revenue floor, while their commercial business acts as the high-growth engine.
Section 2. The Markets Divide. Q2 2026 Evidence.
So we know they have a deep competitive moat, a massive TAM, and an incredibly efficient sales motion. But to understand why the Wall Street divide is so acute right now, we have to look at the exact financial evidence that just dropped. Let's dig into the recent Q 2026 earnings announced on August 3, 2026, right after the U.S. market close. This wasn't just a beat, it was a comprehensive, across-the-board destruction of analyst consensus. Prior to the release, Wall Street expected roughly $1.812 billion in total revenue. Palantir reported actuals of $1.935 billion. Adjusted earnings per share came in at 41 cents, significantly beating the 34-cent consensus. But if you want to know why the bulls are taking a victory lap right now, you have to look at the number that absolutely stunned the market. On the far right, U.S. commercial revenue exploded by 149% year-over-year, hitting $764 million for the single quarter. This right here is the holy grail for Palantir. For years, the main bear thesis was that Palantir was just a glorified consulting firm for the CIA and couldn't scale in the corporate sector. Well, a 149% growth rate in U.S. commercial completely shatters that narrative. It proves that those AIP bootcamps are rapidly converting corporate curiosity into massive, multi-million-dollar software contracts.
And that underlying commercial momentum translates directly to this staggering top-line figure: 93% total revenue growth year-over-year for the entire company. For an enterprise software company operating at a multi-billion-dollar scale to almost double its revenue in just 12 months is incredibly rare. You simply do not see growth rates like this outside of the most disruptive periods of technological shifts. It validates the underlying thesis that they aren't just participating in the AI wave, they are capturing the foundational infrastructure layer of it. This massive acceleration, driven heavily by their domestic adoption curve, is exactly why Alex Karp felt completely justified referring to the U.S. business results as otherworldly.
And even more importantly for forward-looking investors, management didn't just beat the quarter, they significantly raised full-year 2026 guidance across the board. They now expect a total revenue midpoint of $8.15 billion, which represents roughly 82% year-over-year growth for the full year. And on top of that, adjusted free cash flow was raised to a midpoint of $4.6 billion. This reflects an incredibly high cash conversion profile, proving that as revenue scales, an enormous portion of it is falling straight to the bottom line in cold, hard cash. The market reacted instantly to this data, sending shares surging 9.7% in after-hours trading following the announcement. In the short term, this absolute blowout quarter has completely crushed the immediate bear thesis. The evidence shows a company accelerating right into its massive valuation, leaving short sellers scrambling to cover their positions.
Section 3. Business Quality Scorecard.
But look, we aren't just looking at a single quarter in isolation, no matter how spectacular it was. To evaluate if this company is a durable long-term compounder that can actually justify and grow into its 140 times multiple over the next decade, we really need to run a rigorous qualitative analysis on the underlying health of the business model. We need to look at the structural foundation. Synthesizing the data, Palantir earns a very strong blended business quality score of 8.4 out of 10. The highlights here are undeniable, and they really form the bedrock of the bull case. Financial health is a perfect 10 out of 10. They possess an absolute fortress of a balance sheet with $9.2 billion in cash and zero long-term debt. They are entirely self-funding and immune to high interest rates on the debt side. Revenue quality sits at a stellar 9 out of 10, backed by a net dollar retention rate that just rose to an outstanding 157% in Q2. That literally means their existing customers are expanding their spend by 57% year-over-year on average. However, the major blemish on this scorecard is capital allocation, which sits at a 7 out of 10. While they do generate massive free cash flow, the company still relies heavily on stock-based compensation to attract and retain elite engineering talent. Earlier this year, stock-based comp accounted for roughly 12% of total revenue. That is a heavy anchor on retail investors. It represents a real, persistent risk of share dilution. If management doesn't execute highly disciplined share buybacks to offset this issuance, minority investors will simply end up owning a smaller and smaller slice of the pie, counteracting all the benefits of the massive revenue growth.
Now, before we look at the detailed 5-year scenario model that shows exactly what underlying operational assumptions are required for the stock to hit $677 or crash to $50, I want to quickly mention that all of the research behind this video was created using Flash by StockSentinel.ai.
You can generate deep research reports like this one for any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders built to compound for years, hidden gems with asymmetric upside, and dividend hunters with durable income backed by fundamentals. Portfolio Watch monitors your portfolio and flags important changes. Insider IQ tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
If this kind of research-first analysis is your thing, you'll probably want to subscribe. Okay, let's get back to it.
Section 4. 5-year Scenario Framework. Now, before we get into the numbers, I need to be crystal clear. This is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios.
Based on the August 3, 2026 closing price of $125.65, we can model 3 distinct operational outcomes from fiscal year 2026 to 2031. In the base case, to which we assign a 55% probability, Palantir sustains its strong market position with a 35% annualized revenue growth rate over 5 years. This steady compounding leads to a share price of $248.37. In the high case, assigned a 25% probability, Palantir executes flawlessly and becomes the uncontested global standard for enterprise AI. They grow at an explosive 48% annually for 5 straight years, driving the stock to an incredible $677.43.
But in the low case, with a 20% probability, the AI spending cycle cools off, open-source alternatives catch up, and competition eats deeply into their market share. This results in a severe downward re-rating of the company's valuation, crashing the stock to just $50.29 a share.
When we take those three potential futures and probability weight them based on the current evidence, it leads us to a weighted expected year 5 value of $316.02. From the current price, that translates to an expected total return of 151.5% over the 5-year period. But look, price targets are just math on a spreadsheet. They are completely meaningless if you don't understand the operational reality required to actually hit them in the real world.
And this is absolutely the most crucial part of the analysis. We have to look at the operational drivers that build those scenarios. To hit that $677 high case, Palantir must scale its revenue to nearly $58 billion by year 5. Think about the sheer scale of that number. Reaching $58 billion in revenue requires capturing a massive dominant percentage of the entire global enterprise AI total addressable market. It implies they aren't just selling to the Fortune 500 anymore. They're aggressively moving down market into mid-cap companies, requiring tens of thousands of successful bootcamps globally. On top of that, to hit that price, they have to expand their free cash flow margins to a massive 55%. Achieving a 55% margin implies they have successfully transitioned into a pure software-as-a-service model, scaling effortlessly without needing to send human engineers out to handhold every single client. If they can do all that, the market rewards them with a premium exit multiple of 55 times free cash flow. Conversely, let's look at what actually drives the $50 low case. This scenario assumes that hyperscalers like Microsoft and Google finally figure out how to bundle cheap, high-end open-source semantic tools directly into their existing cloud suites, causing intense pricing pressure for Palantir. If Palantir loses its unique differentiation, their free cash flow margins compress to 30% as they are forced to spend heavily on sales and marketing just to retain their clients. In that reality, the market violently slashes their valuation multiple down to 25 times cash flow, repricing them from a monopoly AI platform down to just a mature, slower-growing software vendor. The difference between those two futures rests entirely on execution. And remember, if you want to dive into every single granular assumption behind these models, you can access the full framework in the detailed research report.
Section 5. Core Investment Risks.
That brings us to the actual threats that could fundamentally break the bull thesis. To understand if that low case is a real possibility, we have to ground this analysis in the concrete risks that could cause this extreme 140 times valuation multiple to collapse, because the company priced for perfection cannot afford to stumble on any of these fronts. If we lay out the risk catalysts on a timeline, there are a few immediate warning signs that you must monitor closely. Presently, as we discussed in the scorecard, there is that persistent issue of high stock-based compensation diluting existing equity holders, which acts as a permanent drag on earnings per share. But looking ahead to February 2027, there is a massive, highly visible catalyst, and that is a break clause in the £330 million NHS England Federated Data Platform contract. This contract was supposed to be the crown jewel of their international expansion. However, members of parliament and civil rights groups have voiced serious privacy concerns about an American intelligence contractor handling sensitive British health data. If political pressure forces a non-renewal or cancellation next year, the financial hit would be painful, but the reputational damage, that would be devastating. It would act as a severe early warning sign that European data sovereignty laws and political pushback could permanently cap their international public sector growth.
Beyond international regulations, there are structural and macroeconomic risks deeply tied to Palantir's specific business model. First, because of their ultra-premium valuation, this stock is hypersensitive to long-term interest rates and any broader economic downturn. If a recession causes enterprise CIOs to freeze or delay expensive, transformative AI projects, Palantir's growth rate is going to stall, and that multiple will compress instantly. Furthermore, we have to talk about the forward-deployed engineering bottleneck. While the bootcamps are incredibly fast, Palantir still relies heavily on embedding highly paid, specialized engineers alongside their clients to ensure complex deployments succeed. Now, this drives immense customer loyalty and virtually zero churn, but it is highly human-intensive. It is fundamentally much harder to scale rapidly compared to a traditional, purely automated software-as-a-service model, like Microsoft 365. If they cannot completely automate the onboarding process, their margins will eventually hit a ceiling. And finally, there is the ever-present threat of the hyperscalers. Microsoft embedding Copilot and advanced data layers directly into the software that enterprises already own is the ultimate bundled threat. If good enough AI becomes free or bundled with existing enterprise licenses, Palantir's premium pricing power is going to get seriously tested.
So, will Palantir's extreme multiple compress before it can monopolize the enterprise AI revolution? That is the ultimate tension dividing Wall Street, and it is the exact conflict that will dictate the stock's future.
The three things you need to take away from this analysis are this. First, their Q2 2026 earnings definitively prove that the core economic engine, driven by that AIP bootcamp strategy, is accelerating rapidly and successfully penetrating the U.S. commercial market. Second, they have the ultimate financial safety net in a $9.2 billion fortress balance sheet that makes them immune to debt cycles. But third, at 141 times trailing earnings, the market is priced in a flawless future, leaving absolutely zero room for error. Upcoming catalysts like the 2027 NHS contract renewal and their ability to automate deployments without human engineers are absolutely critical to monitor. Palantir is either building the most important, irreplaceable software monopoly of the 21st century, or it's a phenomenal company trading at an impossible price. The margin for error is zero. If you want the full research, including the deeper framework behind this video, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.